What's happening right now in the precious metals market is something we haven't witnessed in over 4 decades. Gold has surged more than 65% in 2025, its best performance since 1979. But here's what's truly remarkable. Silver has absolutely demolished that performance, skyrocketing 144% in the same period. We're not talking about modest gains. We're witnessing a historic repricing of monetary metals that's sending shockwaves through the global financial system. Let me give you some perspective on just how extraordinary this is. Gold ended 2025 just beneath $4,310 per ounce, marking a total gain of 65% across the year. That's the sharpest rise since the record jump that led to January 1980's historic peak. Silver fixed just below $72 per ounce, rising 144.4% from last New Year's Eve. To put this in context, silver hasn't moved like this since 1979, when it leapt by over 400%. As we move into 2026, the momentum hasn't slowed down. Gold has already pushed past $4,600 per ounce, while silver broke through $90 for the first time just days ago. Analysts are now projecting targets that would have seemed absurd just months ago. Major investment banks are forecasting gold could reach $5,000 per ounce by the fourth quarter of 2026, with some suggesting $6,000 is possible longer term. For silver, the $100 milestone that seemed distant is now being discussed as inevitable, with some experts suggesting we could see $150 or higher if current trends continue. So what's driving this unprecedented surge? The answer isn't simple, and it's not just one factor. We're witnessing a convergence of forces that haven't aligned like this in generations. The first and perhaps most significant driver is what's happening with central banks around the world. They're buying gold at a pace we've never seen before in modern history. Central banks acquired over 1,000 tons of gold annually for the past 3 consecutive years, doubling the pace of the preceding decade. Think about that. The institutions responsible for managing national reserves, the ones with access to all the data and all the intelligence about where the global economy is headed, are aggressively accumulating physical gold. China has been leading this charge. The People's Bank of China added to its gold holdings for 7 straight months through May 2025, reaching over 2,296 tons. But it's not just China. Russia has boosted reserves to over 2,300 tons. Turkey expanded holdings to nearly 624 tons and mandated that commercial banks hold 20% of their reserves in gold. India's Reserve Bank added over 72 tons in 2024 alone. Poland led the buying in the first half of 2025. 23 countries added to their reserves during that period. What's remarkable is that these central banks are buying even as gold reaches record prices. Central banks simply don't need to purchase as many tons of gold to move their gold share to the desired percentage with prices around $4,000 per ounce and above. Yet they continue buying aggressively. This tells you something profound about their long-term concerns regarding fiat currencies and the global monetary system. And here's the crucial question: why are they doing this? The answer brings us to the elephant in the room: the weakening US dollar and growing concerns about the entire fiat currency system. The dollar experienced its worst first half of a year since 1973. The dollar index fell about 11% from January through the end of June, marking the end of a structural bull cycle for the dollar which started in 2010. The greenback lost more than 10% of its value in just 6 months, and analysts at Morgan Stanley estimate it could lose another 10% by the end of 2026. This isn't just a technical market move. This represents something much bigger. For decades, when global uncertainty increased, money flowed into US dollars as the ultimate safe haven. That pattern is breaking down. The combination of massive tariff policies, concerns about Federal Reserve independence, and worries about unsustainable debt levels has shaken confidence in the dollar's stability. The fiscal deficit for fiscal year 2024 reached approximately $1.83 trillion, representing 6.4% of GDP. Total federal debt now exceeds 123% of GDP. These aren't sustainable numbers, and the world is taking notice. Central banks are responding by diversifying away from dollar reserves. Gold's share of official reserves has risen to almost 20%, up from around 15% at the end of 2023. This is a seismic shift. After decades of dollar dominance, we're seeing a structural realignment where central banks are choosing an asset with no counterparty risk, no government control, and no ability to be printed or devalued through monetary policy, they're choosing gold. But central bank buying is only one part of the story. Western investors who stayed away from gold for years are flooding back in. After several years of outflows from gold exchange-traded funds, inflows strengthened month over month throughout 2025. What's important here is that gold ETF holdings remain well below previous peaks, suggesting there's still enormous room for this demand to normalize relative to historical levels. When Western institutional investors fully re-engage with precious metals, which appears to be happening now, it adds massive firepower to the rally. Now let's talk about silver specifically, because what's happening in the silver market is even more dramatic than gold. Silver isn't just a precious metal or monetary asset, it's an indispensable industrial commodity, and that dual nature is creating a supply crisis that could define the next decade of commodity markets. The statistics are startling. Industrial fabrication demand reached a new record of 680.5 million ounces in 2024, maintaining upward momentum through 2025, with analysts projecting a market deficit of roughly 149 million ounces this year, marking 5 consecutive years where demand has outpaced annual mine production. 5 consecutive years of deficits. Let that sink in. The world is consuming more silver than it's producing year after year, and the gap is widening. Where is all this silver going? The answer is the green energy revolution and the technology transformation. Solar panel manufacturing alone has become the largest source of industrial silver demand. Each photovoltaic panel requires 15 to 25 grams of silver due to its unmatched electrical conductivity. The European Union aims to deliver at least 700 gigawatts of solar capacity by 2030, which will require massive amounts of silver. Solar energy now accounts for more than 30% of industrial silver demand, and that percentage is growing rapidly. Then there's electric vehicles. The automotive revolution is driving substantial increases in silver demand because EVs require significantly more silver than traditional combustion vehicles. EVs consume on average 67 to 79% more silver than internal combustion vehicles, with approximately 25 to 50 grams of silver per EV. Battery electric vehicles need silver in battery management systems, power electronics, charging infrastructure, and electrical contacts. The forecast shows global automotive silver demand increasing at a compound annual growth rate of 3.4% between 2025 and 2031, with EVs overtaking internal combustion vehicles as the primary source of automotive silver demand by 2027. And we haven't even talked about artificial intelligence and data centers yet. The AI revolution is expanding data center infrastructure at an explosive pace. Total global information technology power capacity increased by approximately 53 times, from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. More computing power means more servers, more circuits, more connections, and silver is essential in all of it. From 5G networks to smartphones to advanced electronics, silver's superior conductivity makes it irreplaceable. Here's where it gets really interesting. Just as this industrial demand is exploding, the supply side is facing unprecedented constraints. China, which controls between 60 and 70% of the world's refined silver supply, implemented new export restrictions starting January 1, 2026. Under the new policy, only large state-approved companies with annual production capacity of at least 80 tons can export silver, and they need special government licenses. This effectively blocks hundreds of smaller and mid-sized exporters who have long served global markets. Why is China doing this? The answer is strategic resource nationalism. The new policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earths. China needs silver for its own solar manufacturing, its own EV production, its own AI infrastructure. By restricting exports, Beijing is ensuring domestic supply while creating leverage over Western renewable energy transitions and technology supply chains. It's a geopolitical chess move with enormous implications. The impact on global markets was immediate. London's vaults, which have traditionally served as the center of global silver trading, have been emptying rapidly. By March 2025, London Bullion Market Association volumes had fallen by around a third from June 2022 to 22,126 metric tons, its lowest point in years. There's basically no available metal left in London. In October, Borrowing costs spiked so high that to borrow silver overnight was costing 200% on an annualized basis. Traders were stressed, to put it mildly. Physical silver is commanding huge premiums. China has been reported paying premiums as high as $39 per ounce for gold, and similar dynamics are playing out in silver. Companies are approaching miners offering $8 to $10 above market price just to secure physical delivery. This is what happens when paper trading meets physical reality. For decades, silver prices were influenced heavily by futures markets and paper contracts. Now, with physical shortages emerging, the actual cost of obtaining real metal is diverging from the paper price. This is a fundamental repricing of the asset. Looking ahead, the supply situation isn't going to improve anytime soon. Mining output reached a record high in the first quarter of 2025, but annual mine production typically adds only about 2 to 3% to the total above-ground stock. You can't just turn on new silver mines like a faucet. It takes years to develop new deposits, and most silver is produced as a byproduct of mining for other metals like lead, zinc, copper, and gold. This means the industry can't rapidly scale up output in response to demand surges. Now let's connect all these dots and talk about what this means for the broader financial system. What we're witnessing isn't just a bull market in precious metals, it's a signal that the global monetary order established after World War II is under stress. The Bretton Woods system collapsed in 1971 when Nixon ended dollar convertibility to gold. What followed was 50-plus years of pure fiat currency, money backed by nothing but government promises and central bank credibility. That system is showing cracks. The U.S. national debt exceeds $35 trillion. The European Union's combined sovereign debt exceeds $16 trillion. Japan's debt to GDP ratio is over 250%. These aren't sustainable trajectories. Every major fiat currency since Nixon has been printed with no backing, and the US dollar has lost approximately 98% of its purchasing power since 1971, according to Federal Reserve data. That's not a bug in the system. That's a feature. Inflation slowly erodes the value of debt, making it easier for governments to service their obligations. But there's a limit to how far this can go before confidence breaks. History shows us that fiat currency systems have a limited lifespan. Research indicates that fiat currency systems typically survive for approximately 27 years on average, with failures occurring through various mechanisms including hyperinflation, warfare, political upheaval, or complete economic collapse. We're now 54 years into the current dollar-based system. That doesn't mean collapse is imminent, but it does mean we're in uncharted territory. What happens when confidence in fiat currencies erodes? People and institutions move to real assets with intrinsic value. Gold has served as money for over 5,000 years across every civilization. Silver has similar properties plus critical industrial applications that make it indispensable for modern technology. When central banks buy 1,000 tons of gold per year, when Western investors return to precious metals after years away, when physical shortages emerge in silver markets, these are signs that confidence in the paper money system is weakening. Some analysts are now openly discussing scenarios that seemed impossible just years ago. The possibility of gold reaching $10,000 to $15,000 per ounce, silver potentially hitting $150 or higher. These aren't fringe predictions anymore. They're being discussed by mainstream investment banks and professional forecasters who recognize that we're in a structural shift, not a cyclical rally. The implications for silver specifically are profound. We have 5 consecutive years of supply deficits. We have exploding industrial demand from solar, EVs, and AI that's only going to accelerate. We have China restricting exports for strategic reasons. We have London vaults nearly empty. We have investors recognizing silver's dual role as both industrial metal and monetary asset. All of these factors are converging at the same time. For those of us who've been following silver for years, this is the moment we've been waiting for. The fundamentals have never been stronger. The supply-demand imbalance has never been more pronounced. The geopolitical factors favoring precious metals have never been more aligned. This isn't about speculation or momentum trading. This is about mathematics and physics. There's only so much silver in the world. Demand is exceeding supply year after year. Prices must rise to balance the market. What should investors take away from all this? First, understand that what's happening isn't temporary. The forces driving gold and silver higher are structural, not cyclical. Central bank buying, dollar weakness, supply deficits, industrial demand growth, these trends are measured in years and decades, not months. Second, recognize that we're likely still in the early innings of this move. Despite the massive gains in 2025, gold ETF holdings remain well below previous peaks, meaning Western institutional money is just starting to return. Silver's role in the energy transition is only beginning to be recognized by mainstream investors. Third, pay attention to the physical market. Paper prices can be manipulated. Futures markets can be influenced by large players. But you can't print physical gold or silver. You can't create it out of thin air like fiat currency. The shortage of actual metal, the premiums being paid for physical delivery, the emptying of London vaults, these are reality checks that ultimately determine real value. Fourth, understand the broader context. This isn't just about making money on a trade. This is about preserving wealth in an era of currency debasement and monetary instability. Gold and silver have served this role throughout human history, and they're serving it again now. The central banks understand this, which is why they're buying aggressively despite record prices. Sophisticated investors understand this, which is why money is flowing back into precious metals despite years of being told that gold and silver are outdated relics. The question isn't whether gold and silver will continue rising. The question is how high they'll go and how long this cycle will last, based on the fundamentals, based on the supply-demand dynamics, based on the monetary backdrop. We could be looking at a decade-long bull market that dwarfs anything we saw in the 2000s. For silver specifically, the setup is extraordinary. The industrial demand story alone would justify much higher prices. Add in the monetary demand, the supply constraints, the Chinese export restrictions, the physical shortages, and you have a perfect storm. Some analysts believe silver could outperform gold by a significant margin in the coming years, just as it did in 2025 when it gained 144% compared to gold's 65%. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been wildly out of historical norms for years. As that ratio normalizes, silver has enormous catch-up potential. We're living through a historic moment in financial markets. The monetary system that's been in place for over 50 years is being questioned by the very institutions that support it. Central banks are voting with their reserves, choosing gold over dollars and euros. Investors are waking up to the reality that paper currencies are losing value, while tangible assets with real utility are becoming scarce. Technology and green energy revolutions are consuming silver faster than we can mine it. China is weaponizing resource control for geopolitical advantage. All of these threads are weaving together into a narrative that points in one direction: significantly higher prices for gold and silver. Whether you're protecting wealth, seeking growth, or both, ignoring what's happening in precious metals markets right now would be a mistake. The fundamentals have never been clearer. The risks to the fiat currency system have never been more apparent. The supply-demand imbalance for silver has never been more extreme. This is your wake-up call. Pay attention to what central banks are doing, not what they're saying. Watch the physical markets, not just the paper prices. Understand that we're witnessing a repricing of monetary metals that happens once in a generation. The train is leaving the station. The question is whether you'll be on it when gold hits 5,000, when silver breaks 100, when the monetary system that we've known our entire lives transforms into something different. History doesn't repeat, but it rhymes. And right now, it's rhyming with the 1970s, with Weimar Germany, with every period in history when governments printed too much money and people fled to real assets. The difference is that this time, it's happening globally, all at once, with no alternative reserve currency waiting in the wings. That makes gold and silver not just attractive investments, but essential hedges against a system that's showing every sign of fundamental stress. Stay informed, stay prepared, and most importantly, understand that what we're witnessing isn't just another market cycle. It's a monetary revolution.